What is going on, you guys? Welcome back to another video. My name is Brandon. In today's video, I want to talk a little bit about a market update, kind of share with you guys what I'm seeing in the markets. They have been a little bit choppy over the past couple of days, and I hope that this title is not too clickbaity. I hate using titles like this, but I do want to go over some numbers and some statistics that may help you out over these summer months as it pertains to volatility and as it pertains to these choppy markets. Because if you didn't notice over the past couple of days, the markets have been exactly that, a little bit choppy. On Monday, the market started quite low. They opened quite in the red. They did end up climbing through the day and actually, I believe, finished positively. Today, I'm filming this on Tuesday morning. It's only 8:45, so we don't know how this day is going to plan out. But so far, it did start as a red day. VIX has spiked up a tad over the past little bit. And I think that does kind of make sense because if you do keep up with what's going on in our world, it kind of feels like we're in a little bit of a shamble period. Just this week, we had a major earthquake out in Haiti. Prayers to anybody out there who's been injured, or, let's hope everybody's safe and kind of getting things done over there. We all know what's happening in Afghanistan, and it just makes me think how sad it is that people would rather hang on to the side of a plane than to stay in their home country. It's just so terrible. And again, prayers out to anybody affected by that. Here locally, we got fires going on, and thank God for a bit of rain today and yesterday. And of course, we got the Delta variant on the loose. So there is a lot of stuff on an economy level, on a global scale, that could be popping some uncertainty into the market, which makes sense that we are seeing a little bit of volatility. That said, I want to go over a few stats right now that talk about the summer months and why it is common that we see these types of volatility. And I think Mark actually mentioned in a previous video that he put out a prediction that said by August, September, maybe he said September, he would have not been surprised if we saw a market pullback or at least some form of volatility. That was part of our portfolio challenge. He said he wants to deploy more and more money. And I want to share with you a clip here that I found recently, which basically justifies a thought that I've had for many, many years. But it says that the August to October and September to November periods are the two weakest 3-month periods of the year, which suggest a risk of a fall correction. In 1929, the S&P dropped for the first year presidency. Okay, we can skip over that. But if I were to put up more of a visual form of this, it basically displays this very, very well for us that in general, if we looked over the years, and this dates back to 1929, periods such as August, periods such as September, the summer months, they do tend to see more volatility. That's why you get these sayings like sell in May and go away. That didn't just come out of nowhere. There's a reason why people say that, and some people really live by that strategy. Maybe people are just out, enjoying their summer, and there's less attention, there's less volume in the stock market. It's tough to say, but the numbers do suggest that the summer months can be more volatile, and maybe we are seeing that right now. And I love the idea of investors wanting to buy the dips. They want to have their finger on the trigger. You want to be buying. But at the same time, what I would share for you guys, my subscriber base, my viewers who care about this, is one little tip I can share with you is just relax a little bit, okay? Just take a chill pill, take a step back. I think that people look at their quotes far too much, especially if you're a new investor and you're really excited. People they're glued to their computers. They're glued to social media, their stock brokerage platforms. And when you look at your quotes every single day, and you're seeing a stock drop 3%, 2%, or the market's down this or that, I guarantee you will be more enticed to make a purchase. Well, guaranteed you'll be more enticed to make a purchase if you just didn't look at your accounts at all. I do agree that yes, we have had a couple of red days. In fact, I don't think even Monday ended a red day, but we have seen this volatility. But I'm gonna put up a couple of pictures for you and just kind of show you how the markets have done. The markets in general haven't gone anywhere, okay? This is a long-term chart of the S&P. I'll scan over to you for a 1-year chart, and there is no drop. There's nothing really to me that's saying, hey, we need to pile money into the markets right now. We need to buy these dips. We need to buy, because how silly would it feel if you went out and depleted your cash pile when we just start to see a little bit of volatility, knowing that the coming months may continue to be more volatile? If you go out and deplete your cash pile right off the bat because you have such an itchy trigger finger, I think that's actually a mistake that investors can make. Now, of course, if you're seeing value in a stock, that's a completely different idea, and you can buy on dips, and that's in fact what I think you should do. But even in our academy, I'll share with you guys, in our private membership group, we have a channel where students share their trades. They say, hey guys, I bought this today, I'm thinking about buying this, and I'm seeing actually a lot more purchases than even I would go for. And I share that with them. I say, hey guys, I'm sitting on a lot of cash. We'll look at my cash position in a second, but there's no need to jump the gun when it comes to purchasing stocks when we start to see just a little bit of volatility. Because here's a really interesting stat for you guys. This is a stat taken in 2020, so it doesn't factor in COVID, but there have been 26 corrections. And these are major corrections we would define as 10% decline or more. This is dating back to 1946. And what we see is that these corrections on average take about 4 months on the way down and a 4-month recovery. That's an 8-month time period, okay? Pushing a year for this full cycle to come through of a decline of about 10 months or more. If we were to look at this on a bigger scale, there's been 12 major bear markets since this same time period, 1946. And this is again not including, of course, the COVID crash that we recently saw, but these take an average decline of 14 months, over a year, with 24 months of recovery. So these statistics should not be taken lightly. And it's numbers like these, it's data and historical numbers like these that really help me be patient when it comes to investing in the stock market. Again, I know if you're new, it's easy to have that itchy trigger finger, but what I would do, and I'll actually share with you guys what I'm doing rather than just blindly buying stocks on every little volatile period right now, is that I am building cash. And here's a clipping of this is my Quest Trade account, so one of my accounts, but you'll see in my TFSA, I am holding, and there's a huge plane going overhead, I'm holding today, as of filming this video, $15K in cash, which is a huge percentage of cash to be in my TFSA. I'd love to be fully invested, but you have to constantly factor in what's going on with the markets. Where are we? Are we at all-time highs? What are the general price ratios at? Would I love to be fully invested? The answer is yes. And will the markets continue to push on? Possibly. But as a precaution, rather than just buying stocks on dips, I'm building up cash because, again, we haven't really seen much at all of a pullback other than a couple of days. Even as you can see here in our portfolio challenge, which is a bit of a different story because we're still building this portfolio up, we still hold a quarter of that portfolio in cash. So regardless of what your numbers are, you can take that ratio down and you can either scale that up or scale that down to something that's a little more suitable for you. But really the takeaway is this, guys. I know it's a simple video and it's more or less conceptual. We're not diving into why the market's crashing. That's something that even you can study as much as you want. It's very hard to understand why the market does what it does. But from a conceptual level, be patient with your purchases. That's one thing I could share with you guys, especially during a time like this, especially if this is the first batch of volatility you're seeing as a new investor. I've done multiple videos on my biggest mistakes as an investor, or my biggest tips for investors out there, especially beginners. And it's such a simple one, but it is such a powerful one. Stop looking at your portfolio every single day. It does you no good to look at your brokerage accounts every single morning. Maybe if you're a very, very balanced person and you don't think with your emotions and you're able to just be very rational about things, sure, take a peek and see how things are going. But if you're looking at your portfolio bouncing up 2%, 3% every day, or a position you're looking at bouncing, you will be more enticed to pull the trigger than somebody who just literally says, I'm going to check my portfolio once a month, or I'm going to check my portfolio once a quarter. Because as I hopefully was able to display with some of these data points and these charts for you guys, it does take time for these crashes to set in and these pullbacks to set in. And when they happen, you will know, right? You're not going to miss out on an opportunity by not checking in on your computer for 1 day or for 2 days or logging into your brokerage account. Again, once we enter into one of these bear markets or these pullbacks, you're going to know about it. And that's really the approach that I would share with you guys. If you're seeing value out there, nibble away, take your picks, but at the same time, be patient. And even from a non-financial standpoint and level, I think it's a very, very good piece of advice for your mental health, for your sanity, especially in a time like now, is just, take a little bit less screen time. Take some time off YouTube, take some time off Facebook. You don't need to be scrolling through your stuff all day long and just totally absorbed with that. We've been doing this on lockdown for a year and a half already. If the weather calls for it, if you're in an area where you can go outside and get some exercise or just unplug, go do that, because that's better for your mental health, that's better for your sanity, and I actually believe that it'll be better for your portfolio. You can check back in 2-3 weeks from now, and if there's an opportunity at that point, you'll start to kind of recognize it a little more than just looking at your portfolio every single day. So that's really how I would handle this volatile market today, guys. If you enjoyed today's video and the quick updates and statistics that I've shared, please take a moment and drop a big thumbs up, because that does help out more than you know. If you are not subscribed to the channel, take a moment and subscribe, because we post videos like this every single week. If you are looking to learn more about the stock market, you want to consider learning about our academy, there is a link down below. We offer training programs, we offer a membership group. You can learn all about that through our website. But I hope this little update helped keep you guys a little bit on pace, a little bit in line. Take a chill pill, relax, and happy investing, everybody. But I'll take this as a time to sign off, and I'll see you guys in the next video.